Hello, this is Vance, and this is Monday, November the 3rd, 2014. And these are the CL trades, trade lesson 3 of 6. I try to promise like 6 lessons to try to get the whole method in of the slow hand method of price action, so that's what I'm going to try to do today. And Friday, I didn't have a lesson. I didn't have a Friday lesson on Friday because what I did instead was I did the whole day as trading, or my trading morning, anyways, for 2 hours. Then I had to, it only speed up in Camtasia to kind of do the recording because I just ran the tape recording, and then I sped it up. But it only speds 400%, so it only goes like 4 times. Maybe it goes faster, I don't know, I didn't check it out. But it looked like 400% to me. And because even though it would only be 30 minutes, I wanted to cut it down, and so I edited out the dead spots. And I showed the entries of all the trades that I took for that morning, and I also showed at the end of the day what my the chart was as far as my Excel spreadsheet, what I record for my trades for the day, and you could see that what the profit was in the whole bit. Anyway, I'm not doing that every day, and I'm not running a trade room. I'm not doing that, and it just I'm not doing it. It's just the fact of the matter is that I don't find it very comforting doing that because I'm too distracted. I need to concentrate on my own trading, so to participate in a trade room and talk about it is just too distracting for me. I'm conscious of everybody looking over my shoulder and everybody there, so I can only do it for short bursts. So that's what you get. For most of the other stuff that I do, if I do my regular trading, I do it on my own. But yeah, maybe I'll do 1 or 2 sessions once in a while that I can do it, but I found that that's the way I'm going to do it. Anyway, there have been some individuals who are been querying about the validity of this procedure and my method and how I'm going about doing it and the way I'm talking about it or whatever else, or tracking these things after the fact. They're after the fact trades. Well, absolutely they're after the fact. I didn't pretend like I did take every single trade that I marked up. Those are the issues. It's way easier to see after the fact. But the idea is, if you see it after the fact, you see it very clearly, then when you transition to see it real time, then those patterns will review. It will review in your mind, so you see familiarity. It's really like playing chess. A grand chess master remembers all the moves of all the many games that they've played. They might have like the classic games, the classic moves of chess. They remember those moves. And when it comes time to play those games in real time, they can recall those games and they will be able to anticipate or to a better degree what the opponent is going to do. It's very similar to that. So what I'm doing here is like going over this information time and time again, and so that you as an individual can learn it and then maybe apply it in real time. And I'm trying to strip it down to the bare essentials of what I think about for every trade. All these things that I'm talking about, whether it's second entries or tight trading ranges or context or momentum or any of these, and the things I'm going to be talking about today, I have those things in my mind. I'm thinking about those things while I'm at the screen looking at this. And if I seem to go too quickly for a lot of individuals, it's because I'm thinking a lot faster than I can actually speak. And if I'm going through very, very quickly, that's how I trade. So you're getting a glimpse in how it's done. Now, I can only do that after the fact because I have to slow it way down in order to do it after the fact. I mean, while it's happening, it's too fast. There's too many explanations. Each trade would probably take 20 minutes for me to explain. It only takes I'll be in and out of the trade before it even goes by. So that's really the best explanation I can give. So I promise to try to keep these to 10 minutes long. And so I'll do that. So that's just kind of the introduction of why I'm doing that. Maybe I should have had this explanation at the beginning or something like that. But hopefully you'll get an idea of just an overview of what I'm trying to teach. I mean, each individual segment, there's way more to it. But I'm just trying to hit the high points so that you guys can kind of follow this. That's what I'm trying to do. I hope that makes sense. Okay, I've talked about tight trading ranges. I'll go over a little bit about trading them. I've talked about trading channels and how to draw your lines. I'm going to talk a little bit about market context. And there's only really two markets. The market's trending or it's not trending. So it's either trending or it's in a range. That's basically the two current texts of the market. But which is which? Is uptrend, downtrend. And then the four kinds of trades: with trend trades, continuation trades, and reversal or counter trend trades. And all of them are a little bit different, but they're all based on tight trading ranges and trading the channels. It's very simple in that regard. So I talk about a trend trade, I'm talking about with trend trading trades. Or if I'm talking about continuation, I'll talk about that. I'll show that in a second. So let's go with that. Let's take a look at today. Here's today, and here's this morning. So we look at the morning opening. We see that price has moved up from the overnight. It moved up from, let me see if I got this here, because the close, see where it is, like 70.14. That's where it is right now, because the market really sold off right after 2 o'clock. But the open was rated, it was here. It was at 80.59. And we traded down. This was overnight, and then traded back up, and it was this tight trading range. So let me just talk a little bit about this here. This was just before the open, just before 9 o'clock. We had this pretty tight trading range. And the definition of a trading range is price has had a low, it's revisited at least twice, and at the high at least twice. So what you see for a tight trading range is right here. So if this is the top of the range, the price came up twice, at least twice up here. It's really kind of a narrow double bottom. It tests down here. Comes down here, pulls back. You can even call this twice because it kind of punched through this area. You can say that this has really definitely defined it right here. So you can see that this is a tight trading range. Now, how prices respond to this area? If you're looking at a setup for a short, you want to keep your stop above above the most recent price action. If you're looking for a long, you want to try to do your best to keep your price below the recent price action as well. But they're not written in stone. If you have a very strong bull bar or a very strong bear bar, you can go a little bit below this. But either way, what you're really attempting to do is you need to try to enter with, in these cases, a limit order. You try to limit in as low as possible so you get the best, you have the best potential for getting to the other side. Now, where's my target if I enter in here because I expect it to go long? Well, I want to get out before I get to these double tops. That's where I want to be, depending on the structure of this trade. Now, you could have got in a stop limit order here and still got your 15 ticks out, but as you can see, as it got to the top here, it failed. At this juncture, this is a second entry short right here. You could take a stop order, but the idea is that if you could limit in somewhere, like near this top, as price revisited this area, then you're in a better shape to get off before it gets to this bottom, and to at least get your scalp portion or your first portion off. Now, what Al Brooks does, and he'll talk about that at the top of a trading range, most trading ranges, most breakouts will fail. So if you look at this delineated, so let's take a look at this. Let's say that this is originally the top. Price comes back down here, down here. This is almost the top of the range here. It breaks through, but then it fails to come through. So you can see here's a breakout that failed. You can see it came up once, failed, tried to go up a second time, and immediate failure. And if you got in here off of that basis, you'd have gotten your 15 ticks off. Down here, we have this reversal. Now, is it enough? If you limit in from down here with the expectation of price is going to revisit the other side here, doesn't quite get there, but the lower you got in, let's say you got in here, you would have gotten off before it got to the 15 ticks. And of course, when you get into this hesitation here, this overlap, price comes up, overlap, this is where you probably want to close out this trade. Because if you're into this trade, it gets up here, doesn't quite get up and pulls back, this is where you try to get out with a scratch of this trade, because it doesn't look like it's going to head up any further, particularly when you have this type of price attempted to go up the first time, it fails, tries to go up the second time, and it fails again. This is so at the tight trading ranges, you don't want to get in the middle. You try to buy and sell at the edges of these ranges on this time frame. As you can see, that once price collapsed here, once it couldn't get past here, you can see that there was a strong move down to here. So let's take a look at this next trading range here. Price trades down to here, pulls back. Can't get down, pulls back, pulls down. And right here, this is a pretty tight trading range as well. Remember I said 10 ticks? So you can see where you have this reversal, pulls back. First it comes back up here, pulls back, pulls up again. So this is really like a tight trading range. Anytime we get 3 bars side by side, you could say that it's a tight trading range. And with this, with price moving down to this area, and then you have the pullback. Now you can say even went a little bit further. Let's say it goes down to here. First pullback fails, second pullback, and immediate fail, a very strong bar, and look where it wound up. Really toward this exhaustion. So there's a measured move. This measured move from down here to down here. with this trading range here, now, as far as context is concerned, what would you call this particular trade? Any trade along here is a with trend trade because it appears to me that the trend is going down. Got room to get out for these double bottoms here. This is a pretty decent setup bar right here. And even though it's a little bit deep into it, when a bar like that closes, you almost have to take a trade like that almost all the time. And so this is a with trend. You can use a stop limit order on this trade. You could have used that. Trades down to this area. Now, when price gets down to here, you have this first break of this trend channel, and then a break to a new low. So now you're probably looking for an entry. This is a real, more along the lines of a reversal pattern, a break of the trend channel, a test to a new low, and then looking for a place to get in long. Now, you can see price moved down to this area. Here's the price makes a new high. Here's your first entry. You have a pullback. This is a second entry right here, second entry long. But it's at the top of this channel. It's kind of like a failure. I don't know how good that bar is. It's a pretty decent looking bar, but it may come back and retest this area again. My preference would be is that if you're going long is to have, again, your stop below the most recent price action. That's the best place to be, and wait for that type of a setup. And what happens? We get it right here. Now, it's a doji. It's not a tremendously, so you might not be overly confident of that particular bar at first. But it does work out, if you were to get in. This pullback here, you can see this bar. This is a trap. Buyers thought their sellers thought it was going to take prices lower. And when price broke down to this area, it just briefly, it's low enough to test. And if you could limit in down here, below this, that turned out to be a pretty decent trade. Now when it gets to the top, you got room to get up because you see there's double tops right here. It did get a test here. It would almost get up to this one. Yeah, it would have gotten out to here, these double tops. So this is a decent way to get in here. Now this is really kind of a reversal. We don't know it's going to be a reversal. We don't know it's going to be a counter trend. It's a reversal trade. It reverses at least to the double tops here, continues to go up further, and then fails from here, breaks back down. And so now we go into another aspect of what you call a tight trading range. It's almost like a spike in channel. So let's take a look at this from the bottom. So we have price moving up to here. You've got higher highs throughout this area, higher lows throughout here. Now, it's really not a long live trend. It's a pretty short, it's pretty short, so you draw in your channels. It might be even a little lower like this. Originally had it like this, but then it broke through the upper side here. So it moves up to here. So we have this movement up to this area. You have a first pullback. We have a second pullback that's pretty deep. Now, going long here, is that enough of a pullback to go long? Well, I don't know about that. I'm saying that this is kind of like resistance will turn into support. It turns around here, pulls back, and then another time it dips down here, dips down here. So these bars here, this is developed into a tight trading range. Let's say the top of the range is right here, which is 10 to 15 ticks, right along this area. Again, it comes down to the fact that you try to buy down here, but you have to buy early, and you try to sell near these tops. Now this one, here's one here that you got to probably get into, but there's a little bit more room. You'd probably feel more comfortable if price came more up to here before you looked at going short. All right, down here is a little different. If you look at it from the standpoint, as soon as these bars here, this double bottom comes up here, pulls back. Here's a double bottom that fails. Here's another double bottom that fails, comes back down here. Another double bottom that fails. So I would say that the zone should be somewhere like this, okay, as far as an entry is concerned. Now, when you have a strong move down like this one, over these bars, like this fall off, you don't necessarily get on right on immediately to this turnaround. But you can see first pullback, fails, and then it pulls back again. This is a bit of a trap. And if you keep your stop, limit and keep your stop below this one, this turned out to be a good trade to at least test this other side. And you can see that when it got to the other side here, it did hesitate. But then it found then you have first attempt to go higher, or first attempt to go lower, down to here. It failed. And then another attempt. You can see this down? Pulls back down to here, pulls back, fails down to here, and then springs out of here. And once it gets to this top, once it breaks through these double tops here, look at that move. Just moved up very, very quickly here. So this was there was a reason to at this juncture, when it came up here, when you had this pretty strong bar right here, you go long right on that close to that bar. Now, it's a challenging trade to take. You're near this double top up here. It's actually, so even if you take a look at the rules, here's the first time, second time, pulls up here, third, fourth, fifth time. It's bouncing along here. I think you can see that. Same with the bottom. You've got one touch here, another touch here, and if you move this up to here, you can see every time these bars pulled back, this is really kind of the area where it broke through, right in this area. So we're looking at 80, right at the $80 mark, right down here. Found some support and then moved up here. Now, once it broke, here's the first break of the channel, break to a new low. Now, is this a bar to go long on? Well, I don't know. That's the difficult thing. We already came close to testing the overnight high right here. You can see that right to here. This is where your target would have been. And when you have a move up like that, you think that we're going to take up most of it because it was just really news driven or whatever else. And you can see that what happened. It in fact took it all back. It pulled back, news driven. You tried to break a new chart here. Here's another tight trading range, but this is to the downside. Price moves down here the first time. He says it moves up, pulls back, moves up again. And look at these strong bars. This is a place if you're going to sell, you're going to sell up here because now the trend is kind of established in a downward motion. Now you don't know that this is going to happen. So as a result, what you have to do, you have to really, you see that? You have to limit in near these tops. And if you limit in with a portion of your contracts, here's your 15 ticks down here. You're going to have to limit in like here, somewhere in that neighborhood and keep your stop as high as possible for it to have enough room so you don't get taken down on noise. But you can see here's the move down here, another tight trading range here, fails back down here. Let me just move this up. And that was, this is at just after 2 o'clock. This is 2:50. And this movement here, this happened from 2:16 to about 2:30, so 14 minutes. So there was a lot of sellers waiting resident down here. As soon as it broke, as soon as price broke down this area, you can see that. And let's take a look at the lows for the day, right across here. Well, it's a little bit lower. But look at where this bottom of this range was. It had some hesitation here because there were still buyers down here. But once those buyers were overwhelmed, they just gave it up, and look at that move down here. So that's what happened on the downside. There was buyers down here, but these sellers, just too strong, overwhelmed the buyers, and when the buyers gave it up, they just kind of dumped, and that's why prices move down so rapidly, and there's just too much weakness here. There's too many sellers and not enough buyers, and that's why price went down any further. But you have to also remember that anytime you have a price transaction took place is because there was buyers willing to buy this at lower and lower prices. You know, the sellers were making the money, of course, obviously, because they had control of the market. And that's pretty much it. So, well, 17 minutes. So what I've talked about right now, let's take a look at that again. I talked about trend channels, continuation patterns, and reverse. Now, the reversal counter trend, the only difference between reversal and counter trend trade is the fact that it's at the bottom of a channel, typically at the bottom of a tight trading range, and a counter trend trade, it's a reversal, but a counter trend just goes longer and farther. That's the only difference. Continuation, you can see that. You know, when price trades down into a range, it pulls back in the tight trading range, and then trades out and in the same direction as the original trend was. So, and then the trend trade is just with trend itself. And that's it, basically it for now. So this is Vance. I hope you enjoy this. Bye for now.